hosted by Emkay Global Financial Services. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kishan Rungtana from Emkay Global Financial Services. Thank you, and over to you, sir.
Thank you, operator. Good evening, everyone. I would like to welcome the management of SG Finserve and thank them for this opportunity. We have with us today Saurabh Dhawan, CEO, Sahil Sikka, COO and CFO, Anubhav Gupta, Group Chief Strategy, and other senior managements with us. I shall now hand over the call to the management for opening remarks. Over to you. Thank you.
Thanks, Kishan. Anubhav Gupta here. I welcome everyone to Q3 FY25 earnings call of SG Finserve, and thanks for dropping by. As promised, over the last earnings call, we have started to scale up our loan book. We have almost doubled our loan book from September quarter to December quarter. The loan book which we closed last quarter was 1,568 crores, which is up 92% quarter on quarter. This is after we got Type 2 license from the RBI. We have started getting sanctions from banks. Today we have limits from 6 banks, and we are talking to half a dozen more number of banks, which will come over the coming quarters. So as we stand today, the equity capital of the company is around 1,000 crores, plus 340 crores has to come in preferential capital form over the next 15 months. So we have a very clear foundation to take this loan book to 5,000 crores in next 2 to 3 years. And this much of business we can generate from the existing anchors whom we are talking to. In our presentation, we have given a very detailed snapshot of how this 5,000 crore loan book will look like. And the good part is that the group, what we are expecting is to contribute not more than 25%. The rest 75% will be from third-party anchors, which consists of very large reputed conglomerates and companies similar to APL Apollo level. On this loan book, we expect to generate ROE of 18 to 20% with ROA of 4 to 4.5%. So this is what on basis of this we have developed our business model for the next 2 to 3 years. We believe that it's a very unique business model what we have developed, where we are only focusing on the supply chain funding and only for the distributors channel financing, which no other NBFC or even large or mid-sized banks are focusing on. So we see a clear space where we can continue to grow our loan book with the minimal number of headwinds over the next 2 to 3 years. And as you can see, our track record basis on the gross disbursements, what we have done so far, the number of bills we have discounted, which speaks of our tech platform over the last 2 years, which we have developed with 0 NPAs and the gross disbursement cycle, which comes out to be 35 days. So this gives a clear demonstration of the success of this business model, and with all regulatory headwinds behind and a strong capitalization on the balance sheet, we see a very strong trajectory for loan book expansion with desired ROE and ROAs. Saurabh, you want to add to
Thanks, Anubhav.
The third quarter results, please?
Yeah. So good evening, everyone, and welcome to the Q3 FY25 investor call for SG Finserve. It's great to have you with us today as we celebrate our best quarter in terms of quarter-on-quarter growth and highest ever profitability achieved in a single quarter in life of SG Finserve. Despite the challenges we faced, including regulatory hurdles earlier this year, we've come out stronger than ever. The quarter's success is a testament to the trust of our customers and anchors and dedication of the team. So loan book grew from INR 822 crores in September 24 to 1,568 crores, which is about 90% quarter-on-quarter jump. And operating income grew from 31 crores last quarter to about 42 crores, which is growth of 37%. And interest income is up by about 30%. Most importantly, PAT grew significantly by almost 68% quarter-on-quarter basis, achieving 23.69 crores, which is highest ever PAT in life of SG Finserve. With this momentum, we can assure that we continue to maintain our targets of achieving loan book of 4,000 crores and 6,000 crores in financial year 26 and 27 respectively. Now, what is required to achieve the same is equity, bank debt, and anchor tie-ups. Would be happy to share that all the required ingredients are in place. So we boosted our capital base now at about 1,000 odd crores. We expect that it will reach to about 1,500 crores by FY27, out of which about 350 crores is committed preferential money which is to come in. Number two, our relationships with our anchor partners, including Tata Group, Jindal, Vedanta, AMNS, and we added some known anchors like Polycab, Whirlpool, and Tata Steel dealers. Existing MOUs, the program limits that are in place, aggregate to about 5,000 crores. So there is a clear-cut blueprint which is available to grow our business to about 5,000, 6,000 crores of loan book over next 2 financial years. So bank has already assessed our consortium limits of about 2,600 crores and sanctions are underway. So we will, and we've already received credit rating of AA, A1 plus from both ICRA and CRISIL ratings. So now we already received sanctions of about 750 crores and many more will flow in over next few months. Importantly, we continue to maintain our yield of 13% and cost of borrowing is about 8.5%. So our solid spread of 4% is maintained. In conclusion, the quarter reflects the culmination of our collective efforts and strategic vision. We set a new benchmark for excellence and poised for sustained growth in quarters and years ahead, achieving the committed performance. We extend our heartfelt gratitude to our stakeholders, customers, anchors, and employees who will be integral to our success. With that, we open the floor for your questions, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Gaurav Shukla, who is an individual investor. Please go ahead.
Good evening, sir. Congratulations on good set of numbers. Thanks for giving me opportunity.
Gaurav, your voice is echoing. Could you please speak closer to the mic?
Okay, sir. Sir, am I audible now?
Better.
Okay, sir. First of all, sir, I want to know that how many new MOU has been signed with any new anchors? How many new anchors you added in the list this quarter?
How many next quarter? So Gaurav,
in this quarter, sir.
So thanks, Gaurav. We have signed 3 MOUs in this quarter, which is Whirlpool, Ingram, and Polycab. Right. Overall, our anchors are 40 now, and we have total program size signed off of close to more than about 5,000 crores now.
Okay, sir. Thank you, sir. And sir, in last phone call, you have said that your loan originality system, AOS and MS integration with banks. Sir, in last con call you have said that 3 banks integration has been made. Any new bank is added or not, sir?
Only one bank integration added, and that completes our requirement because that is for the payment side. Collection side, we are integrated with majority of the banks, but for the payment side, we integrated with 3 banks, which solves our purpose.
Okay, sir. And in last con call, sir, you said that new calendar year you will plan to 24/7 banking system till night 2 o'clock. Is this happen, sir?
So it will happen on 1st of February. We are delayed by 30 odd days because of integration underway with the banks, because there is involvement of the banks. So we will be launching that on 1st of February.
Thank you. The next question is from the line of Vishal Singh from Finvestor Financial Advisory. Please go ahead. Mr. Vishal, I would request you to unmute your line and speak, please. Due to no response.
Am I audible, sir?
Yes, sir.
Yes, Vishal, you are audible.
Thanks for the opportunity and congratulations for many things. I won't count them. Just 2 of the questions have been answered. One question is left. With this robust growth in what we are expecting in near future in loan book, what are the chances of NPA? Though it is good till now, nil NPA. So what are the chances?
See, Vishal, chances of NPA will be there, but they are low because we've already witnessed that the role of the anchors and the importance of the dealers for the anchors is really important. So anchors also come and support in times of requirement. So the chances are low, and we have witnessed that.
Thank you, sir. Good to hear that. Thank you, sir. Nothing more to add.
I would like to add on to the same. So you can assess that on various parameters. So one is our portfolio at risk or stage 1, stage 2, stage 3 assets. They are all very controlled. So first, those parameters or those things will influence, and then only the NPAs will come into question. So our overdues and PAR are all controlled. That is, portfolio at risk are in a very controlled fashion and manner currently.
Thank you. The next question is from the line of Rohan Mehta from Fincom Family Office. Please go ahead.
Hi. Thank you so much for the opportunity. Am I audible?
Yes, Rohan, you are audible.
Yeah. So my question, I have 2 questions. So the first one is, in the last quarter, we saw distributors were facing inventory losses, due to sharp decline in steel prices. So what impact do you anticipate this may have on the, creditworthiness of the distributors and dealers? And secondly, are there any other implications for SG Finserve?
Thanks, Rohan. To answer on the inventory losses, we have mentioned that our net cycle, wherein the client procures the material and pays it back to us, is close to about 30 to 35 days. We have not witnessed any major increase in the overdues or delay in payments from any of the steel traders. So they have continued to pay us on time, before time, as they have been doing. And we feel that because of the small cycle that we operate in, this will continue in a similar fashion.
Rohan, Anubhav here. So on behalf of the ecosystem of APL Apollo, where our dealers did face inventory write-downs in the second quarter. See, it is never like that a distributor will end up making a loss, okay, if the steel prices are going down. Although there was severe crash in the steel prices in the second quarter, but the dealer would still end up making marginal profit or say breaking even, right? Because he's churning his inventory say in 20-25 days. Similarly, if you see APL Apollo or SG Mart results in Q2, none of the companies reported losses, right? Our profit margins were halved, but none of the companies reported any loss. So similarly, our channel partners behave in the same way when they are churning their inventory every 20-25 days. So they don't have to incur any loss, right? So which would prevent them from making payments to SG Finserve or other banks, right? Why only SG Finserve? They are running limits with multiple banks, multiple NBFCs, multiple fintechs. SG Finserve is one of the financing arm in their overall portfolio, right? So in steel trading, I mean Q2 was the quarter of test, I would say, when prices crashed so severely, right? And still, I mean, no challenge for the manufacturer as such in terms of incurring losses, no challenge for the channel partners, and similarly, no challenge for the financiers of the channel partners.
Right. Correct. Thank you for the clarification. And just on that point as well, so how would you assess the current health of the supply chain sector? So would you consider, considering as a company, I'm sure you likely model negative scenarios in your internal assumption. So how far are we from those assumptions in the current environment, considering how Q2 was?
You'll have to repeat the question, Rohan. We didn't get it.
Okay, sure. So first, what I wanted to know is how do you assess the current health of the supply chain sector? That's the first part of the question. And the second part is, I'm sure you as a company would make internal models with different scenarios, especially the negative ones. So in your internal assumption, how far are we based on how the current environment is?
So if you ask me how many scenarios, sensitivity analysis we do numerous before onboarding a customer. At present, have we got any clues of any liquidity or slowdown issues from any of the dealers of these anchors? Answer is no, because the cycle that we are operating is really small. Churning continues to be there. We continue to receive about 40 to 50 crores of repayments a day, and disbursements, procurements continue to happen in the same way. There is very important factor in this, Rohan, that the kind of anchors that we are dealing with are really fast-moving items, right? And these are all well-established branded names in the industry. They all are industry leaders. That's why in our last call also we had mentioned that we are going to keep focus only on these large anchors where the item is moving on its own and the money is being received and there is value in the dealership. That is why the dealer is paying us right on time.
Rohan, Sahil here. To add on, just to mitigate, so if you see in our presentation, we currently have tie-ups with around 40 anchors. All would be leaders or fast-moving goods manufacturers in various sectors. So this mitigates the risk of one sector or one industry facing any challenge. So overall, if we see the health of the supply chain sector will be dependent on both the MSMEs, how they are performing, as well as the OEMs. So considering and will be dependent on the overall economic scenario. So the kind of diversification in terms of the anchors we have mitigates this risk of any one sector facing a challenge.
Right, got it. Thank you so much. And just a final question. On your cost of borrowing, you mentioned currently you're getting at about 8.5%. Where do you see this from a year from now, assuming that there are no NPAs and the sector is doing well?
We expect it to come down. But we will ensure that we continue to maintain a spread of at least 4% and upwards. But yes, when it comes down, it will come down at an overall financial sector level. So we'll have to pass on some to our customers as well. But the endeavor is to keep the spread minimum at least at 4% level.
Sure. Got it. Thank you so much.
Thank you so much.
Thank you. The next question is from the line of Rajesh Jain from RK Capital. Please go ahead.
Hello, sir. Good evening. I have 3 to 4 questions. So first one is like today you are financing the distributors and you have MOUs with the anchors where you have stop supply arrangement with the principal company from whom the distributor sources. So when you eventually start your retail finance business, how will you guarantee the repayment there? Will you have a similar stop supply arrangement there also, or what will be your model there?
So when we enter the retailers, we would have already considered the entire database and their run with the particular distributor, because retailers would only be the ones which are operating with the existing distributors who are our borrowers. We will have stop supply from the distributor at certain anchors. We can also get stop supply for the step down. There are certain brands which give stop supply for the retailers as well. But otherwise, we will have to rely on the distributor and also take an underlying contingent guarantee from the distributor when financing the retailers. So the mitigant here would be that we will be taking guarantees from the established distributors who've been operating with us for at least 2 to 3 years with SG Finserve.
Okay. And when are you likely to start this retail finance business?
In the next fiscal year only, please.
Okay. And so my second question is, in the last call you mentioned that when you were explaining your business model for the distributor financing, you said that you keep a charge on the assets which are funded by you and receivables generated thereon.
Yes.
So how do you manage to keep a charge on the assets? Or can you give some more context on this? Because when the inventory leaves the principal company and goes to the distributor, and which asset you are referring to, and how will you manage to keep a charge on those assets?
The charge is kept on the assets which are procured from the funds given by SG Finserve. So the charge becomes a property of our borrower, and we have a charge filed with the ROC that all the inventories and the receivables generated thereon, there is a floating charge which will be on their assets, on the assets of the borrower.
No, but the borrower would eventually be selling it to the retailer, right?
And then we will have charge on the receivables, because once he sells it to the retailer, that there will be receivables which will be coming to the borrower. We will have charge on that borrower, on that receivables. It's a floating charge which continues on the books of the borrower. Yes.
Okay, understood. And in the previous call, you had given an indication that you expect your quarterly disbursement run rate to be 5,000 CR per quarter, if I'm right. And this quarter you would have done, I think, 4,600 CR, right?
Yes.
Gross disbursement.
Yes.
So was it just a ballpark estimate or anything which has led to lower disbursements?
So it was just a ballpark estimate, but this is expected to increase in the next quarter, because the disbursements happened in the last month. Majority of the book was increased in the last month. So this will be much higher when we reach the next quarter. This is a quarterly number. So month on month, have we reached a run rate of about 5,000? Answer is yes, but this will be much higher when we do the next quarter. Okay.
And so my last question is, you said that it's not that NPA cannot happen. So in which hypothetical situation would you have to take a hit, not just a technical NPA, but maybe a write-off? In what situation can it happen in your model? Because you have MOUs, you have stop supply agreement, you have personal guarantees of the promoter. Only if the promoter goes bankrupt, that is only scenario, or what else is the scenario in which you can have an NPA?
If bankruptcy of the dealer / our borrower is the main scenario. Intention is something which can never be controlled. Otherwise, if someone is continuing dealership for last 5, 7, 10, 15 years, they would not want to give that up. So that has been the comforting factor when we started this business, and that is what has been witnessed each day, because the value of the distributorship is livelihood for that dealer, so they don't want to give that up. So bankruptcy is one of the only scenarios, or maybe you can say doing some other activities or getting a hit somewhere else and the impact coming onto the business of the company. That is the only one scenario. So we keep a close check that I would have also mentioned in the last call that end use of funds is one of the major things that we keep under our control, because every penny, so this 4,625 crores has been disbursed directly to the anchor, and inventory of this much money has been procured and delivered to these distributors. So end use of funds is very well monitored by us.
So the only factor that would be Sahil here. So the only factor that would be deterioration in financial or credit worthiness of the borrower, and in the background of that, there may be many factors leading to that deterioration. So the main aspect would be deterioration in the credit worthiness of the borrower.
Okay. So when you say you monitor the end use of funds, I mean, you are giving funds to the anchor, and obviously the anchor being a very established anchor having pan-India presence, I mean, obviously the funds will be used for the purpose for which it has been given. So, but the concern would be like I mean, do you also track any end use at the distributor's end, like that he cannot sell inventory and and utilize the funds for something else other than repayment? I mean, you cannot do all those things, right? So what is exactly the meaning of end use here? When you say you monitor the end use, because you are giving funds to the anchor only, right?
When we do the disbursement, we are sending the money directly to the OEM or the corporate or the anchor. So the end use is automatically monitored in that case, that whatever goods our borrower has to purchase, we are paying on behalf of the borrower to the OEM. So the end use is automatically monitored in that case. However, when the dealer receives funds from its debtor, or our borrower receives funds from its debtor, and he somehow doesn't pay to us or any bank or financial institution, so that I don't think can be monitored.
Okay, sir. Okay. Understood, sir. Okay. Thank you so much. Thank you.
Thank you.
Thank you. The next question is from the line of Nemi Doshi from Geojit PMS. Please go ahead.
Hi team, congratulations on a great set of numbers. Most of my questions have been answered. Just wanted your sense as to what is the penetration that we have achieved within the anchor segment, since we have seen a jump in AUM on a quarter-on-quarter basis. So just wanted to get an idea as to the incremental share of AUM. Has it been more from our existing set of anchors, or the new anchors onboarded have led to this growth?
It is a mixed, but new business is coming from the major focused anchors, which includes Tata Group, Vedanta, Jindal. So they are more focused, and we are getting more business from them. But at an overall level, we've seen growth in each and every anchor that we've been there. But penetration at an overall level, as per their channel finance requirements, is still low. That is why we always say that there is a huge scope which is available for us. So there is a good runway which is available for us, because penetration continues to be low.
Okay, got it. And yeah, sorry.
No, please.
Yeah, just one clarification on the same as well. Do we only onboard customers which are registered with the anchors, or do we onboard distributors which other than the anchor?
So we finance the distributors wherein we get a recommendation from the anchor. There is a one-pager recommendation letter which states the previous track record, number of years they've been distributors, and what is the projected business and how much limits are required. And then only we finance these dealers, distributors.
Okay, got it. Thanks.
It is mandatory that they have to be under the umbrella.
Okay. Perfect. Thanks. All the best for the future quarter.
Thank you.
Thank you. The next question is from the line of Harshit from Premji Investments. Please go ahead.
Hello. Hi, sir. Am I audible?
Hi, Harshit. Yes.
Hi. Congratulations for the results. We just wanted to understand on one aspect that currently the distributors whom we are funding, say within the pyramid of that anchor, would these be, say, 100 to 500 distributor, or maybe the mid layer of the pyramid for them? That's the point number one. And the second point, so we do not fund any retailer or basically sub-distributor at this point of time, if I got it correct, because you said that we might start it from the next year. And the second question, sir, would be that for a distributor, say a Tata Steel or any Hindalco whom we are funding, typically how many other lenders would be there similarly in similar supply chain financing? So, for example, if we look at players like Mintify or many of the newer ones, or maybe mid-scale SME bankers, then how much would the overlap be, or the customer typically prefers to just borrow from single lenders, or the kind of wallet share he wants to maintain within 341? Thank you. Hello.
Yes. So you said about the pyramid, we are extending credit to all kinds of distributors. They can be top of the pyramid or middle of the pyramid. But we might not be the first or the second preferred. We might not be the first or the second banker to the A category dealers, but we are certainly third, fourth, fifth banker to them. And even in the large anchors like Tata, Vedanta, we are like the third, fourth. We are there. Retailers, yes, we will be starting retailers. We haven't started yet, but we have identified 4 to 5 large distributors of our ecosystem, APL Apollo, which have been banking with us for past 2 years with a clean track record, and we have been maintaining, scrutinizing the data of their top retailers, and they are old distributors of APL Apollo. So we will be launching this very early in the next fiscal. And 3, multiple lenders. Yes, in a lot of our large anchors, large dealers, there are multiple lenders, and we are happy even if we are third or the fourth banker, because it gives us, it is like our credit gets a certificate that it has been scrutinized by other large institutions like Axis, ICICI, and Kotak. We're happy to be one of the multiple banking lenders to the large dealers, distributors.
So just one additional question on that part. The reason I asked that, for someone who would be, say, borrowing from a Kotak or an Axis, the cost of funds advantage will definitely be to the other lenders versus us. So is it or is there an illusion? The cost of funds advantage is not very high. So if we are at 16%, say someone to the same dealer, if Kotak or ICICI would be Axis to be funding, it will also be somewhere around 15-16% itself.
So we are not lending at 15-16%. Our lending to the large anchors is 12 to 13%, wherein the banks would be lending about 11 to 11.5%. There is a differential of from 50 basis points to 100 basis points. But again, I said that we might be the third, fourth banker. It is as per requirement. Banks also have limited appetite, and we have seen that we've been able to make entries into some well-known distributors of large anchors. So there is good play which is available for us.
Got it. So if I may ask just one more question, is that for the third or fourth position also, who would be our typical competitors? And if you look at startups like Mintify, are they actually comparable to our business model? Or if you can name a few players who would be in that range itself, in the third, fourth, fifth category lender to the dealer.
So I can divide this, that banks in supply chain finance are lending between 9 to 11%, and then it is financial institution NBFCs, which include likes of Aditya Birla, Tata Capital, Hero FinCorp, and we are directly in competition at many places with them. And 13 upwards are the smaller NBFCs and smaller players which are into supply chain finance. So 11 to 13.5% is a play wherein we have larger NBFCs, but no one is focused only on supply chain finance. We have an advantage that we are very clear that we will we are doing supply chain finance, and that is how we are covering all the dealers, distributors. For example, when we tie up with an anchor, we get database of the entire dealer distributor base of that anchor. So we've got coverage team on the ground, which is covering each and every dealer distributor and looking for conversion. Because we know that the number of dealers distributors now will increase drastically. So that coverage also acts as an advantage for us to get ahead in the competition.
Why would that not be with anyone else?
Harshvik, see, you got to also understand the DNA of SG Finserve. Okay, this is coming from a group which has been into manufacturing for last like 35 years, right? Dealing with at least 2,000 direct channel partners. One in steel pipe business, second in PVC pipe business. Put together, we are dealing with 2,000 channel partners for last 35 years. Okay. So we understand, as a manufacturer, we understand what is the requirement for a dealer. Okay, while he is dealing with a anchor like APL Apollo, right? Whether in steel pipes or PVC pipes. So we have developed the product, the offering, the solution in a way which is like very, very user friendly. Okay, for the channel partner, right? We understand like how he is thinking to buy material, how he is going to move his inventory from his godown to retailer, right? What we have to monitor, right? What are do's, what are don'ts, okay? I mean, and on top of it, if you look at the history of APL Apollo tubes and Apollo pipes, right? Since these companies have been listed, you can check our annual reports. The default APL Apollo tubes or Apollo pipes has seen, right, doing thousands of crores of cumulative revenue in last 15-20 years since our annual reports started coming out. The default, you would see the cumulative default, NPA or default or bad debts is not more than 15 crore rupees on like thousands of crores of revenue we have done, right? So this is the DNA, okay, of SG Finserve. So this is number one, I would say USP, okay, that it is coming from the house of a group which has been into core manufacturing, understands dealing with small SME traders, channel partners, right? And that's how we have developed our product offering and solution, right?
Understood, sir.
We are proud to tell you that among like 70-80 NBFCs, non-bank institutions which are being run today, right, in India, none of the NBFC is focusing 100% on this single product, which we are doing.
Understood. Got it. Sure, sir. Done. Thanks a lot. Thank you.
Thank you. The next question is from the line of Rakesh Pal from KRSP Capital Limited. Please go ahead.
Yeah, thanks for the opportunity. Am I audible, sir?
Yes.
Yes, Rakesh, you are audible.
Yeah, my question is, sir, like you have given the target ROE of 18 to 20%. So I would like to know how it will be achieved and whether it considers any NPA coming in future and the timeline to achieve it. So that's my question, sir.
So it's a simple maths on a loan book of 5,000 crores. We shall be having equity of around 16 to 1,700 crores. Right, and the balance will be funded from bank borrowings, right? So our yield rate today is 13 to 14%, which will go up as we go down to the retailers. So our yield rate will expand a bit, right? Our cost of borrowing is among the lowest in the sector, right? As you would appreciate. Right, and over the next 3-4 years, as per the RBI norms, we are already provisioning what is minimum criteria, right? So you do simple math, you will come out at like 400 crore PBT and 300 crore PAT number.
So by FY27, we should be achieving it, like you given this guidance in last con call.
Oh, yes, I mean, we are more confident than we were during last earnings call. I mean, that's why, I mean, with all that excitement, we gave this pie chart in our presentation, where you can see that how the 5,000 crore loan book could look like.
Okay, sir. And my next and last question is, sir, after we receive the money in form of equity, what will be our book value by that time? I mean, the equity total equity at that time.
So right now the equity base is 1,000 crores. We are expecting, so we will be getting another 340 crores. So it will be about 1,340 crores. And flow back of the profit of next year will be about 100 crore plus. So about 1,400 crores at the end of next financial year.
Number of shares will be 6.6 crores. So book value should be around 225 rupees per share.
Okay. Thank you, sir. Thank you. That's all from my side.
Thank you. The next question is from the line of Vedant from Clearview Capital. Please go ahead.
Hi, am I audible?
Yes, Vedant.
Yes, sir.
Yeah, thank you for the opportunity. Just, I wanted to understand a few dynamics around these MOUs, right? So, couple of aspects. One is, for example, say Tata Motors has a financing requirement of 15,000 crores. Then what is the worth of MOUs that they sign with, all the financiers? Is it like they sign MOUs worth 30,000 crores and then the financiers have to compete within them? Right. And the second question is related to the first, that how should we read this, say, 500 crore number? What is the probability of, the dealers off taking that full 500 crores, or do you have to again compete with financiers within that 500 crore as well?
So Vedant, when any of these large anchors are signing MOUs, they are very, very cognizant of the number that they will sign off for. Because all these MOUs are backed by board resolutions. So they are not signed off by any sales official. They are signed off backed by a board resolution. So they're very cognizant, and these are the kind of internal targets after extreme scrutiny that they're onboarding a financer, and they are confident, and they internally circulate that this is the kind of business that we're looking with these financiers. And there is continuous monitoring also happening, that in case we are rejecting more cases, we are sanctioning more cases, our TAT is slow, fast, such kind of monitoring also happens at anchor level. So this is an underlying number which we, as well as the anchor, are extremely cognizant to achieve. And there are timelines as well wherein we have to achieve this. If you'll ask me about this 5,000 crore, this should be achieved end of next fiscal, but we're saying that maybe we're able to achieve about 75%, so that will give us a runway book of about 4,000 crores for the next fiscal. But yes, there is an underlying number, mathematics, basis which this is signed off by both the parties.
Okay, got it. But can you do you have an assessment of the ratio of, say, MOUs to the requirements that they have, that each anchor usually signs with?
That data, but do they sign off a lot of MOUs and new MOUs? Answer is no. When a new financer is entering, they are extremely cognizant of the reasons why they are signing up a new financer, and the number that they are taking is considering their projected numbers and their projected requirements. So there is a mathematics that happens at their level, and they are also answerable that if they sign for 500 crores, they should be achieving that in right timeline. So they do not have too many MOUs which are signed with any financial institution, because we are a new entrant in majority of these anchors. So there is a mathematics which happens before signing of these MOUs.
Got it. And just one last question. Like you said, in the 18 to 20% ROE build-up, what would be your cost to income assumption when you've scaled up to, say, 5,000, 6,000 crore AUM?
So our cost to income currently would be in the high single digit or initial double digit numbers. So our endeavor is to reduce that cost to income ratio on a continuous basis. That is done by introducing more and more technology in our system, in our ecosystem, so that the overall cost that is gradually coming down. So the significant cost for any financial institution or bank is the employee cost. So that is the main endeavor, by introducing technology, how to keep that in control.
Got it. Okay. Thanks.
Thank you. The next question is from the line of Ayush Vimal from Clearview Capital PMS. Please go ahead.
Yeah, thanks for taking my question. I just had one question. Hypothetically, if another company was to develop the same technology, have the same SAP integrations that you have, how easy would it be for them to crack MOUs with anchor clients? I just want to assess what are the entry barriers in the sector, given somebody else also is able to replicate the technology that you've developed.
So technology is one piece, and getting an entry to these anchors is, I think, the biggest barrier that one would have, because these entries into such well-known anchors are not easy. So I would give weightage of at least 75% of getting entries into these large anchors and 25% on technology. So yes, technology is something which can be replicated, but it will have a cost, and it will take time, the kind of time that we have spent. But major thing would be tie-ups with these anchors.
So, and if we have to list down our USPs for SG Finserve, so USP number one will be, of course, the initial runway which we got from the group companies, APL Apollo, right, Apollo Pipes and SG Mart, right. So we could easily build up the book of around 1,000 crores and have the learning curve. Second USP will be one of the lowest cost of borrowing of funds, right, because of the credit rating. Third is the pedigree of the group, which gives us entry to larger groups like Tata, JSW, Jindal, ArcelorMittal, Vedanta, etc., right, which would not be easy for anyone. And fourth USP would be again the DNA of being a manufacturer and dealing with hundreds of channel partners for many years, and learning that how to service them, right. So same DNA in this business in the form of a finance solution offering.
Lastly, so competition is already existent in the market in the form that there are other financiers as well who are into supply chain finance and are competing on good, and they also have good technology and are competing with us on that front. However, when it comes to commercials, that is another aspect. With our good credit rating that we aim to maintain in future as well, that also plays a very pivotal role in this.
Got it. And just to follow up there, from what I understand, SG Finserve was conceptualized post-COVID when APL Apollo had actually stopped giving credit to its channel partners, and it was observed that channel partners were still continuing to borrow at very high rates despite cash discount being available upfront. But I just want to know one thing. For the new loans that you're disbursing, what percentage of loans you're disbursing to new to finance customers, and what percentage of loans you're giving to those who already have credit from other sources?
New to finance would be extremely low, maybe less than 5%. Rest 95% are already availing finance from some other institutions.
Okay, you got to understand. You got to understand that the anchors whom we are targeting, right? Their dealers would be well entrenched. They would be doing hundreds of crores of business already, right? And they would be having banking limits with top private banks, top PSU banks, and top NBFCs. And new age fintechs would be running around to get business from them, right? So yes, we are not going to small part-time anchors or small part-time distributors just to get a business.
That's fairly understood. So the incremental growth that you look to achieve from here onwards, from the 1,500 crore loan book to the 6,000 crore loan book, that would primarily be driven by which of the three factors? Is it the market that will be growing? Is it the fact that you will be able to gain more market share versus other players that a particular distributor is dealing with? Or is it new to finance customers? I think the third one will not exist because you said you hardly deal with new to finance. But is it the market growth or is it market share that you're looking to gain?
It is market growth as well as market share, but more from the market growth perspective.
Got it. Thank you, sir.
Thank you. The next question is from the line of Andrew Purushottam from Kovo Advisors. Please go ahead.
Yeah, hi. This is Sangeeta Purushottam from Cogito. I wanted to follow up on the previous question that if your customers are primarily well-established dealers and they are not new to finance and could possibly be the third or the fourth provider, what is the key advantage that they see in dealing with you? Why do they onboard you at all?
So we are one of the, I think at present, I can say if we have disbursed close to about 36,000 crores, we funded purchases worth 36,000 crores. So we are an established player when it comes to supply chain finance requirement amongst all these anchors. And the testament is that all these anchors are giving reference of SG Finserve to their dealers and distributors for additional requirements. So I don't think there is any question that why are they not going to the banks and coming to SG Finserve. I think we've established ourselves in the supply chain finance industry, and because 36,000 crores of disbursements talks about itself, whether it is convenience of banking, the time that we take to decide on, the kind of applications, the disbursements and 24/7 banking, the kind of monitoring, digital documentation, all that put together is a very well suited and convenient, customer-friendly product that one gets.
Right, but they also end up paying a little more for that product, right? So there is a difference in the interest rate. So if I'm a large dealer and I'm already dealing with maybe one large NBFC and maybe one other bank, I am actually paying for the convenience of dealing with you based on all these factors. And why is it that the others would not be able to provide me? I'm just trying to get to the hub of the matter, that what drives business to you? I'm not getting a complete sense of that. And is there not enough capacity in the system that they're able to get these funding from other people? So, if you're taken on as a third or a fourth player, or even as a second player, I can understand. Third or fourth, what would be the driving force? Because you do have fairly stringent conditions also attached to it, so you have these anchor MOUs and you have a lot of hypothecation taken, etc., etc. So it's not as if dealing with you does not have a cost, right? So what is the advantage which offsets that cost?
When we talk about practically, what has been happening is that the preference has been coming to us because of clear focus on supply chain finance. When I look at competitors, the supply chain finance business for them is minuscule. If I look at Kotak on a 5 lakh, 6 lakh crore book, their supply chain finance book is only 4,000 crores. Why are they not focusing? Why are they not doing? Because they are still concentrating on the vanilla products, which is giving cash credit limit and looking for collateral, whereas we are giving supply chain finance, end-use back limit, and not taking collateral. I think that is also one of the advantages that happens when people are banking with us. And similarly, if we look at Tata, in spite being the ecosystem, their loan book, their supply chain finance book is only 10,000 to 12,000 crores, nothing more than that. In spite having the entire Tata Group ecosystem, and entire Tata Group, Tata Steel, Tata Motors has signed up with us. So that also says that there is a requirement, there is a risk appetite that every financial institution can take on a particular dealer distributor, and they want to diversify, and we are one of the options readily available when they look at sharing of risk.
Right. Okay. And in terms of
sorry to interrupt. Ma'am, I would request you to please use your handset. Your voice is not clear.
Yeah, sure. So in terms of the ease of dealing with you, what is it that you bring to the table? Like, how is your product more suitable to the requirements of your audience?
It is convenience when we talk about onboarding process. It is entirely digital. And onboarding can happen in about 48 hours time, including all the legal documentation, signing. And when it comes to invoice financing, there are SAP integrations with these anchors which are available. All the invoices flow from the anchor SAP to our system, and the discounting happens every 15 minutes. If it is a PO-backed funding, the borrower can come onto our platform and disbursement happens again in flat 15 minutes, which is not happening by other competitors. So that's the feedback that we have received, and all other feedback that we are receiving. We've been continuously working on improving our processes. So I think that convenience has given us an edge over, and it is about practical user experience. So it is when we started off, few distributors that we started off, the word of mouth that has spread amongst the distributor fraternity of a particular anchor, that has given us a lot of new business.
Okay. So if I were to just sum it up, are you saying that a distributor comes to you because he has a certain requirement which is not going to be met by his number one and number two lender? So because either they don't have the risk appetite to give him more or whatever other reason, and he finds it more convenient to deal with you on a day-to-day basis, and for that he's willing to pay that extra 1.5% that you charge. Is that an accurate summary?
He also wants to diversify his risk. He also doesn't want to keep only 1-2 bankers. When you become large,
right.
If you keep only 1 to 2 bankers, you will limit your growth, and the time taken for them to fulfill seasonal requirements, quarter end requirements, that also becomes elongated. And with us, that kind of ease of financing, Diwali requirement, quarter end purchase requirement, all that ease of financing and practical financing has been an edge.
So right. It's like even on personal level, right?
Yeah.
You are running a home loan. It may be with bank A, car loan maybe with bank B, your credit card with bank C, right? Your business loan with bank D, right? So as an individual, we tend to work with like multiple banks, right? For a business, it makes even more sense, right, to diversify the financing requirements through multiple financiers available in the market.
Right. Okay. So then coming to your, the other point I wanted to understand was your total addressable market. So you're saying you have visibility of about a 5,000 crore book based on the anchor MOUs that you have signed. Now, for 5,000 crores of business to come to you, the total business of that